Hey everybody, Chuck Barone. Friday, June the 23rd, 2003, rounding out this crazy ass week this week. Man, guys, I gotta say, it's just whipsaw city, man. The market can't figure out which way it wants to go. Leaves investors really stuck because very difficult to put money in this market right now when you're getting whipsawed day after day by just the strangest things happening. It's not a great time to be speculating right now, unless you really have plenty of time and experience to do it. Anyway, before I get rambling, let me welcome everybody to the show, and of course, thank you guys for your support. You guys watching these videos, keeping us going every day. We appreciate you guys. We really, really do. All right, so let's look at these markets today. So as we know, Powell in front of Congress Wednesday and Thursday, markets digesting all that information, deciding they don't like it. So markets down today. Stock market, not a happy day. Dow down 219 points, 33,727 on the Dow. The S&P down 33 points, 4348 on the S&P. And the NASDAQ down 138 points, 13,492 on the NASDAQ. Now, these are not dramatic declines, okay? But I think they kind of set the market's tone moving forward into next week until data or Federal Reserve or something changes the direction. There really is no direction right now, so it's a little bit like being in a bumper car or on a pinball table where you're just bouncing around and you have no idea where the next bounce is going to take you. This market just schizophrenic right now and really not having very much direction at all. All right, so there's the stock market. Not a great time. Bond market. Today, go figure, yields falling. So people buying bonds today. I guess that's natural when the stock market's selling off. The 10-year down 6 basis points. 3.74% on the 10-year. The 2-year down 5 basis points, 4.75 on the 2-year. So we had the perfect 100 basis point, 1% inversion. Now it's back down to 99. But, bond yields still inverted, warning of recession. Yields up and down and all around, can't figure it out. Even though obviously the trend is going to be higher. Okay? Let's look at it like this, okay? Even in a normal yield curve, where the shorter the term, the lower the rate, and as the term gets longer, the rate rises with the length of the term. So if we had a normal yield curve right now, imagine where rates would be, guys. You get an overnight rate, 5.1. You get a 3-month rate around 5. You get a 2-year rate now sitting at 4.75, which I'm guessing would be 5.5. You got a 10-year rate now at 3.74, which I'm guessing would be about 6.5 without this inversion. So the market really betting on this recession, betting that rate cuts are coming, at least the bond market betting that way. It's going to be fascinating to see how this all unwinds with the bond market surrendering and raising yields on bonds in a giant sell-off, or the Fed, the bond market hanging on long enough until the Fed actually decides to start cutting rates again, which does not seem likely this year. So 6 more months of the bond market with just no certainty and whipsawing rates. Fascinating stuff, guys. The dollar today, up very small. It's 102.87 on the index. So coming back, it was down to right around 102. So back up, closing in on 103. The dollar, kind of being steady. It's going to move a little bit up and down each day. I think the more hawkish talk we get from Powell and the Federal Reserve, the higher the dollar is going to go, obviously. So the dollar standing strong. Metals today up small in the face of a rising dollar, which is kind of good news for gold and silver. Gold up $6.90 per ounce at $1,920.60 per ounce. Silver up 17 cents per ounce at $22.42. Metals hanging in there. I'd like to see these numbers a little bit higher. But coming off recent highs, and in the face of a hawkish Fed and a rising dollar, metals holding on, doing well. Oil today down very small, down 6 cents per barrel for West Texas Intermediate, sitting at $69.45 per barrel, pretty much just as we've been telling you guys. It wants to be trading between 70 and 75. It breaks out either up or down out of that trough occasionally, but pretty quickly goes right back to where it is. I still say the price bias on oil is down, not up. So we'll see where it goes. Right now, sitting just under the $70. Bitcoin today up $748, $30,896. Was over 31,000 today. Bitcoin rocket rally. Hey man, go Bitcoin. I think for the people who watch this show that are holding Bitcoin, happy days, man, right? For the skeptics, well, you know what, guys? We can't always be right. But Bitcoin, certainly in the face of everything it's been dealing with, terrible news in cryptos, crypto exchanges, the players in the game, everything, very little positive news. Yet, here's Bitcoin holding its own. Certainly very, very far from its highs, but pretty far from its lows as well, right? All right, so let's talk about the markets today, wrap this week up. I read this interesting article. I got to say, man, investors, schizophrenic right now, don't know up or down, right or left, where the heck they're going. So I was reading today, investors sold off equity funds this week, selling off mutual funds. $16.47 billion worth of equity funds, U.S. equity funds. Obviously a side effect of Powell's remarks in Congress this week. Powell sounded pretty hawkish. Markets have some fear now that recession might be coming, the Fed might go too far, sell off stocks, right? Now, interestingly, just last week, investors bought $19.7 billion worth of U.S. equity funds. This is a perfect demonstration of what I've been saying to you guys, bro. There's no certainty, completely uncertain on Wall Street, at the Fed, about what the Fed's, what they're going to do, where they're really going to end this game, and the market uncertainty goes right along with that. Even though the Fed has telegraphed every single move, the market apparently not wanting to believe what the Fed is saying. So fancy marketing. But Powell, he was the reason today, or this week, that bonds and mutual funds selling off like they are. As I've said a million times on the show, guys, raising interest rates does nothing to bring down inflation. Raising interest rates brings on a recession, which then dampens demand and brings down prices. So, the idea that the Fed is going to engineer a recession is not a surprise to me. You guys have all heard my definition of a soft landing, right? Picture the Hindenburg. So I feel sorry for investors right now. It's a tough time to be in this market. If you're doing the things that we've been telling you to do, you're not having it as bad. You're not selling all your equities, buying back in the next week, and just going crazy like this market is. So hang in there, guys. It's going to be all right. We'll get through this. All right. Commercial real estate. The crisis continues to get worse. Now you have big institutional investors, Blackstone, Prism, BlackRock, walking away from big properties. You got a perfect storm against commercial real estate holders. You have trillions of dollars worth of commercial real estate coming due, which typically is just rolled over and refinanced. But it's not going to be business as usual this time because, number one, commercial buildings having a big tenancy crisis, as we all know. The work from home idea is something that workers love, not their bosses so much, but the regular working man is not hating it, not having to commute every day, right? So commercial real estate, tenants, there are none. A lot of buildings empty or massively vacant with 30 to 50% occupancy rates. So these landlords, rather than trying to refi these properties at rates significantly higher than the rates they have now, are choosing to just walk away. To commercial loans, with no person is going to suffer any kind of real credit hit. What's going to end up happening, guys? You guys probably saw the article, the largest mall in San Francisco. Huge mall. The landlord just walked away, defaulted. So banks are going to end up owning a gigantic share of commercial real estate. Sadly, it's mostly these smaller regional banks, which are already having a very difficult time right now with, the Fed raising rates. So you got this perfect storm coming in commercial real estate, and I don't really see how they're going to engineer their way out of this one, guys. Those loans are either going to be refied or paid off or defaulted. There's really not any other options. When you're talking $1.5 trillion, could be big. So we'll see where that goes. You had Yellen out today talking in Paris. I don't even know how this person got to be where she is, but rambling on about bank mergers coming because banks aren't as profitable. I love this stuff. She said because smaller banks are having to pay out interest rates on their savings accounts and money markets, that it's denting their profitability. So basically Yellen is saying that paying market rates on your savings or your money market eats into the bank's profit because cheating you obviously is part of their business model now. I mean, how does this lady become chairman of the Fed and Treasury, Secretary of Treasury? How does that happen? Crazy. Anyway, interesting paper. I saw a little bit about it. I haven't gotten into all the complete nuts and bolts of it yet. The Fed paper going to be talked about over this next week. You'll be hearing about this next week. The Fed and the European Central Bank have a plan in place right now to continue to reduce liquidity in markets, continuing to reduce reserve funds stored in banks. Talking right now it's $6 trillion. They're talking about reducing it by 50% or more. So the Fed and the ECB seriously pulling liquidity out of the markets right now. This is all liquidity that was pumped in pandemic and stimulus stuff. They feel like, with stimulus no longer necessary to, stimulate the economy, that these funds are in excess, and they can pull these funds out of the market. We'll see where it goes. What's interesting here is at the same time they're doing their thing, pulling liquidity out of the market, now that they've fixed this debt ceiling issue, you got the Treasury in there up to their eyeballs, borrowing money. I was reading that they would need to borrow $1 trillion before September 1st. So the Treasury is going to be in there borrowing money, which, sorry guys, it's also a liquidity drain. So you got the federal government with the Treasury borrowing money like crazy, and the Federal Reserve with pulling liquidity out of the markets like crazy. It's going to be tough, man. It's going to be very difficult for consumers. You're going to see a credit crunch coming. It's going to be difficult to get consumer loans. They're going to raise their standards. There's not going to be much money to go around for those with all of this stuff happening at the same time, right? And, this is where you're going to start seeing unhappy consumers getting their credit card limits chopped. That's already been going on, but it's going to accelerate now. Very difficult to get consumer loans. You'll see more and more of people going to these shadier ass payday loans or title loan deals. People get desperate. They got to have the money. They do what they got to do. If they can't get it from their bank, they're going to find a way to get it somewhere else. So anyway, a crazy week finished. I'm hoping we don't, but I'm sure we got as much crazy coming next week. We'll be here to bring you guys all the details. Go have a great weekend. I fully intend to have some fun, relax, spend some time with my bride, and You know, try to get some stuff done at the house, get away from this crazy stock market and work for a couple of days. You guys do the same. Enjoy your families and your friends. Relax, unwind, because next week we'll be right back at it. Have a great weekend, guys. Until then, until Monday, take care.